This is one part of a 5-part series. At the end will be a link so you can watch the rest of the series, as well as a link to my calendar to schedule a free 30-minute consultation where I'll personally be able to go over a review to see what your options are. You don't have to be rich to get started, just start with where you are today. There's a misconception out there that you have to have a large sum of funds in order to get started with your own banking system, but that's not true at all. We can start today by using the monthly disposable income that you might currently be putting towards savings or putting towards trying to get out of debt. Make sure you like, comment, and subscribe, and don't forget to ring the bell so that way you'll be notified when I post new videos just like this every week. Einstein said, "Compound interest is the 8th wonder of the world. He who understands it, earns it, and he who doesn't, pays it." Albert Einstein also said, "If you can't explain it to a 6-year-old, then you probably don't understand it yourself." So let's keep this really simple. There's 3 parties involved in banking. I want you to decide who you would rather be. First, there's a depositor, which is a person who goes down and puts money in a checking or savings account at a local bank. That bank is going to pay you maybe 1%, right? Second, there's the debtor, or the person who's going into debt, who takes a loan and pays maybe 4 or 5% on a home, maybe 9 or 12% on a personal loan, and maybe up to 25% on the credit card. And lastly, there's the bank. The bank uses OPM, other people's money, and gives each dollar more than one job. What do I mean by that? The bank is allowed to loan that same dollar up to 10 different people. It's what they call fractional lending. So for every dollar that somebody deposits in their bank, they can give that same dollar more than one job and loan it out to 10 people or more. Now, if they only made a 1% return over what they were paying, then they would make 10 times the amount in interest. But do banks loan money out at only a 1% margin? Heck no. Lending is a huge business that we all know. Why do you think banks have marble floors? They can take that same money and make 500% to 1,800%. So who would you rather be? The person making the deposit that is out working for money and only getting paid 1%, which is about half of what the rate of inflation is. The person who's a slave to the bank, paying nearly twice what a home is worth in interest payments, not to mention compound interest on credit cards, ATM fees, and other miscellaneous service charges. Or finally, would you like to be the banker? The banker uses other people's money and can give that same dollar more than one job. So when you're the banker, your money works for you rather than you working for money. Have you ever heard the saying, if you're just working for money, then you'll be working the rest of your life? So let's take a look at how this looks for a typical American family, how we can go from debt to liquid tax-free funds. We have Dave and Bonnie, Dave who's 45, Bonnie who's 41. They both desire to retire at age 65. Total combined monthly income is $7,050 a month. Desired retirement income is $5,000. They have 3 children, ages 13 to 17. They only have about $3,000 saved for college at this point, and their major concerns or desires that they want to accomplish is to reduce their debt, have more money for emergency savings, increase their retirement income, save more for their children's college fund, get their spending under control, and create a family banking system. So let's look at Dave and Bonnie's debts. Dave and Bonnie are pretty typical. The average American has almost $250,000 or right around $250,000 in total debt. They have just over $200,000, $202,461. Their total minimum monthly payments currently are $1,872.43. They've got a couple credit cards, some financing for their car, student loans, furniture, and of course their mortgage. Now let's add up the debts and take a closer look at what's really going on here. Now, if I were to ask Dave or Bonnie how much debt they were in, they'd probably say around $200,000 to $202,000, right? But that's not the whole story. Once we add up the interest that they're going to pay, that's over $389,000, close to $390,000 total. That's almost twice the balance that they're paying now. Now, how do you think that makes them feel? Well, how does that make you feel when you consider that what you think you owe is not quite, but almost half of what you're actually going to pay? The Get Off Debt report will itemize each debt as well as exactly what month each debt will be paid off. Infinite Family Banking is a world of guarantees. This system will work exactly as it's shown here as long as you do your part. Now, as we pay off each debt, we're going to stop sending money to somebody else's bank and start putting that monthly amount into your bank. For example, in 3 months from now, when they pay off that MasterCard, they'll no longer be sending that $63 to somebody else's bank, and we'll start putting it into their bank. Again, no more money comes out of your current budget. We just use what you currently have. When you've paid off the second debt, we're going to put that $63 plus the $65 into your new bank until all your debts are paid. Now, this is a point where everyone is just dying to know what this would look like for their debts. I'm sure you're thinking the same thing, right? As we stated in the beginning, there's a link below in the description for you to see this illustration drawn up specifically for you and your family or your business. The consultation and illustration is free, and we find the funds that are already in your budget so it doesn't cost you any more money than what you're spending today. If you have additional funds that are available or some money that's set aside in savings, we obviously can utilize those funds as well. Now, we won't need account numbers or anything like that, but we will need to know the interest rate and how much you owe, of course. In this example, we're going to show how much this saves if we pay off all debt, including the mortgage. Some people might be asking, Mike, but if we choose to do this program, do we have to pay off our home? Maybe they plan on moving in the near future, or they want to have that extra $100,000 to $150,000 as liquid capital that they can invest in rental property, maybe go back to school, open their own practice, or maybe start a business. Remember, this is just a written plan to where you are today and where you could be in the future. You are always the one that's in control, as this is all your money. When we go over your individual program, we'll go into more detail to show you the freedom and options Infinite Family Banking can give you. For now, we're just going to keep this discussion very simple. Whether Dave and Bonnie decide to pay the home off early or not, in 30 months, which is really only 2.5 years, all of their debt will be paid off except for their mortgage, which frees up close to almost $1,000 a month. That already cuts Dave and Bonnie's monthly debt obligations to more than half. In 7.9 years, they'll have enough liquid cash available to pay off the remaining balance of their mortgage if they choose. So I have to ask you this question. If you had enough liquid funds to simply write a check and pay off your home while you're already debt-free of all their obligations, would you really consider yourself being in debt? This is another discussion that we can have when we look at your individual situation. But if Dave and Bonnie were to ask me that question right now, I would just let them know that they've got 7.9 years to think about it. They can decide what's best for the two of them and what gives them the most peace of mind. Now, mathematically, a case can be made that they can make even more money for retirement than what we're about to see here by paying off everything except the mortgage and letting that capital compound inside their banking system or by making other investments. Of course, that's all after they get out of debt, which is the reason we're having this conversation in the first place. For now, let me state this. I've never, ever heard anybody regret that they paid off their mortgage. So to keep this simple, and for the rest of our example, we're just going to assume they're just going to pay off the mortgage. So let's take a step back and you tell me if Infinite Family Banking has made Dave and Bonnie's life just a little bit better or if it's been a whole lot better. Well, they're debt-free in 7.33 years versus 22.27 years, so that's pretty significant. Dave is debt-free at age 52 rather than age 75. Remember, he wants to retire at age 65. They stopped wasting that $139,000 in interest and able to put that back into their pocket. We were able to help them free up $1,872 plus every month for retirement, which is over $22,469 more cash every year. Now, some people can think of that as they just got a raise. Some people would think that is even better. As Benjamin Franklin said, a penny saved is a penny earned. But actually, a penny saved is better because we don't have to pay taxes on money that we save. That's all cash right in your pocket. Now, that gives Dave 13 years of additional retirement savings over and above anything else he and Bonnie were able to do now or into the future. Now, not including compound interest, $22,000 plus over 13 years is $292,000. Now remember, these are funds that are already in their budget without them cutting back on their lifestyle. Remember, their monthly take-home income is over $7,000. The problem that most people have isn't that they don't make enough money, it's that they're using it like a debtor, not like a bank. Since Dave doesn't want to work until he's 75, after he pays off the house, if he only puts $1,592.75 into his banking policy, when he gets to age 65, he'll have $463,756 of liquid tax-free retirement funds. And if he were to die at age 65, Bonnie would receive tax-free $977,018, which is only 20-30 grand shy of a cool $1 million to take care of Bonnie. So how much would it cost Dave and Bonnie not to do this system? Well, it would start off with costing them over $139,000 in just interest that they would waste. It'd be a waste over $1,872 plus per month that would just be going towards bills that would never go back to their pockets ever again or benefit their family. It would also be a cost of possibly having to downsize their home if they wanted to retire at age 65. A lot of things can happen to someone's health or their personal situation or financial situation in 20 years. Maybe they wouldn't be able to work the way they want to, or maybe in the same career. There's also that cost that they possibly wouldn't be able to retire if they still had 10 years left on the mortgage. There would be that cost of having to pay $893 of that monthly mortgage payment if they wanted to keep their home and to keep on working until age 75. That's over $107,000 that he would have to make just to keep a roof over their head, and again, have to work 10 years longer than what he really wants to. They would lose out on the $463,756 of liquid tax-free retirement income at Dave's age of 65. And they'd lose out the peace of mind that if Dave, God forbid, died at age 65, that Bonnie in her estate would not be able to inherit that additional tax-free $977,018. So I know everyone's thinking, I wonder how much it would cost me if I didn't utilize infinite family banking. Click the link in the description below. There you'll be able to have access to my calendar and be able to have a free 30-minute consultation with me where I'll personally look at your situation and see how the infinite banking concept can benefit you reach all of your financial goals and dreams. By clicking the links on the screen, you'll be able to watch either the full webinar or the next video in this series. Don't forget to subscribe, like, and of course ring the bell so that way you'll be notified once I upload new videos just like this one every week. Thanks, God bless, and have a great day.